Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And our guests for this week's show are real estate experts Matt MacFarland and Amanda Han. Now, Matt and Amanda are co-founders of Keystone CPA. Matt is executive managing director, and Amanda is assistant managing director. They are the co-authors of the book on tax strategies for the savvy real estate investor. Powerful techniques anyone can use to deduct more, invest smarter, and pay far less to the IRS, which is what we all love. That's not part of the title there, but we do all love paying less tax to the IRS. And guys, just real quick, want to remind you of something before we get on to the show with Amanda and Matt. I mentioned it here in the last few shows, but if you haven't done so already, just a reminder, go grab your free copy of my best-selling book, which was released back in the springtime. It's called The Cash Flow Investor, How to Create Financial Freedom Investing in Commercial Real Estate. You can go grab that free copy by going to kevinbupp.com/free book. Again, kevinbupp.com/free book. And this isn't just some little white paper or 20-page ebook. This is a legitimate full-blown book. It's for sale on Amazon right now for $20, but for my loyal listener group here, I've made a copy available for free. So go grab yourself a copy now. Don't know how long I'm going to make that offer available for. And so with that, guys, I'd like to welcome Matt MacFarland and Amanda Han. How you guys doing today?
Good, Kevin. Thanks for having us.
Yeah, we're excited to be here to talk about real estate and how we can use it to save taxes.
Let's talk about not paying taxes, right? I add that to the title of your book up there. So it's a subject that we all enjoy talking about, and I'm excited to get into the meat and potatoes with you guys. But let's start by kind of passing it back to you for a few minutes. And I gave you a very brief introduction there. Why don't you tell our listeners a little more about Keystone CPA and what it is you guys do?
Yeah, well, we are a boutique CPA firm that we help real estate investors all over the country to proactively plan and save on taxes. We are real estate investors ourselves. I'd say probably 90% of our clients are real estate investors, running the gamut from full-time investors to more, passive investors on the side type of thing. We are a married couple, so those titles that you gave at the beginning, I think we need to reverse those. She's not an assistant to me in any stretch of the imagination. It's definitely the other way around. So
I know it should be like women-owned business or something, right?
I like that.
Yes.
Well,
yes.
Well, fantastic. Well, excited to have you guys here. So talk to me about, I guess we'll start by laying a foundation. What ultimately made you choose real estate as the path that you guys wanted to focus your practice within?
Yeah, that's a great question. So I actually I'm the third generation of real estate investors in my family. My grandparents invested in real estate. My parents dabbled in real estate. But, I kind of was taught the traditional route. Go to school, get good grades, get a stable job. And what job is more stable than being a CPA, right? And so I just happened to end up in the real estate specialty group. My first job out of college was in one of the big four accounting firms, and I happened to be in the real estate specialty group. So that's kind of how I got exposure to real estate taxation and real estate tax planning.
Okay. Yeah, and I also started at the same big four accounting firm. That's where we met, and kind of my aha moment was I was working in the private client advisor group, but kind of high net worth individuals. A lot of them have real estate, obviously. Yeah. But I remember once specifically, I was probably 23, 24 years old, and I was looking at a gentleman's tax return, probably in the 60s. He was retired, and you're looking at Schedule E, and you're adding back all his depreciation expense, and it was just kind of, I was like, this guy's making over $200,000 in cash flow, and he's like not working. I was like, ding, 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 right? I'm not paying any tax. Yeah. So that was kind of my aha moment as to, wow, this works, and this is a good thing to be in. And that's kind of how when we decided to start our own practice, we wanted to focus on real estate because that's what we like and what we enjoy, what we understand.
And ultimately, I mean, now that we're, this is going to come out in a few weeks from when we're recording here, but still we're in Q4. I mean, we're kind of in the, ram and jam cram stage of figuring out the final tax planning for a year, especially for those that have got some gains that they want to offset. And so I'm going to ask you guys, I'm going to start this off by asking you, it's a fairly loaded question, but ultimately I think it will allow us to take one of many different paths of where we go with the show. And so it's, how do the rich legally not pay income or capital gains taxes?
That's a loaded question.
That is a loaded question. I mean, ultimately, this is
Yeah.
a real estate show, so we're going to talk about leveraging real estate to help afford the ability to not pay capital gains taxes or income taxes. And so,
Yeah.
I'm going to leave it at that, and I'm going to let you guys choose which path we go, because there's just
Yeah.
a million different answers there, and I get that, but.
Yeah. Well, I mean, I think, for the wealthy, what they do is they invest in assets, right? And their income are from investments versus kind of, the average person, most of the income is from earned income, like a job or an active business that they might be running. What's really interesting was New York Times came out with an article about a year and a half ago where they talked about, it was, I think, 3 gentlemen who were very high income that paid very little to no income tax. It was Elon Musk, who else? Warren Buffett? Oh no, Bloomberg,
And
Jeff Bezos. I don't know if you had a
so
chance.
kind of wealthy guys,
Yeah, sort of wealthy guys. So they did this whole research, dig deep, and say, hey, these guys made a ton of money, but they paid little to no tax. And what was so interesting was they referenced a couple of these highly advanced and unfair strategies on it's like, how did they do it? So a couple of the ones that stood out, one was they were able to not pay taxes on appreciated assets. And so when we talk about, obviously for them, it's a lot of businesses and maybe real estate, but for real estate investors, it works the same way for us, right? We buy a rental property. If it's a commercial property, we buy it for $1 million, it appreciates to $2 million. We don't have to pay taxes on that, right? We don't have to pay taxes until we sell. So we've quote unquote made money, but it's not money we have to pay taxes on.
So yeah, that's the crazy and illegal strategy that the super wealthy are using to not pay tax on their appreciation. But when they go and sell, obviously, I mean, you're looking at capital gains taxes. I mean, there's 1031 exchanges, there's installment sales, there's deferred sales trusts. I mean, there's a whole slew of things people can do to not pay taxes, and it's just a matter of what we see in our practice every day is a matter of planning ahead, right? Have that conversation way in advance of when you're going to actually sell the property, right? So you can kind of put the ducks in a row, if you will, right?
Yeah. I think one of the other things they said in the article was these wealthy people were able to access cash without paying taxes. And so we were just thinking, okay, let's equate that to real estate, right? And that my example is, okay, a $1 million property is now worth $2 million. So as investors, we refinance cash out, and that's not taxable right now too. So it's these highly advanced strategies that they talk about in New York Times are really the same ones that everyday investors use all the time.
So we can be friends with those guys. I mean, it's totally normal.
No, it's a beautiful thing. And as we go down this path of conversation, talking about, more so at looking towards the future and really planning out a strategy with your clients, how you work with your clients. One of the things that that I think will ultimately, I could see some folks getting in trouble down the road. Folks that have made passive investments as limited partners or even active investments. It doesn't really make a difference whether they're passive or active, that have taken advantage of accelerated depreciation, and then ultimately have decided, shortly thereafter, a couple of years after, to sell that asset, right? Like we just saw one of the most phenomenal real estate markets that we've ever seen in the last, 3 to 4 years. And, ultimately they took that loss years back, but now they ultimately have the recapture to deal with. And, one can, continue. I guess they could choose to do a 1031, kick the can down the road, but at that point, you pretty much have to play that game forever. And so what do you advise your clients that's kind of in that predicament, I guess you could say, to where they're looking to plan ahead? Maybe they don't want to keep the asset they're in, and obviously they got the recapture looming and staring at them in the face, and their option might be a 1031 or what else? Like, what are some other creative strategies that one could select to avoid having to just get smacked by the IRS?
Yeah, I think one that comes to my mind is a lot of our clients have been using it. It's kind of we kind of refer to as like a lazy 1031 exchange. So they're sitting on selling a property, and maybe it's a passive, syndicated investments are going to get a K1. They're expecting a couple $100,000 a gain. They're looking at, potential depreciation recapture. Well, maybe they don't want to be in that asset anymore, but they're still going to be in real estate. And so sometimes our clients will just reinvest that money into another property or another syndication investment that's going to generate more depreciation. or do a cost tag on a property they own, where they can generate enough depreciation that they can use to offset that gain. So that's a way to, time it in such a way that it's not a 1031 exchange per se, but they've timed it and they're getting a deduction the same year they're expecting the income. So that's doable when you know what's coming down the pipe and you have that conversation and you can kind of plan ahead for sure.
Yeah, I think we see that a lot more. We're seeing a lot more of this lazy 1031 in the last year or so. And I think the reason is because for some investors, it's a little bit more difficult, especially people that are investing in smaller deals, that they're finding it more difficult to find the right replacement property, right? So if I have a single family home in California, I'm selling it, I want a 1031 exchange into something, but all the properties are like over asking. And so instead of doing that, and you don't want to pay the taxes, so maybe I take that money and I reinvest it into like a syndication deal, mobile home park, an apartment building. And as long as those properties or those real estate are kicking off tax losses to me, I can use my syndication loss to offset the gain on the single family home that I sold personally. Right. Yeah. So we're seeing more of that just based on like deal flow and what people want to get into.
Sure. What are some of the most tax efficient asset classes that you have found? And I'm sure they run the gamut in your practice with your clients, but what do you find to be the most favorable?
You mean within real estate?
Yes, within real estate, correct.
Within real estate,
and actually, I'd like to maybe answer it both ways because it just let's expand our horizons a little bit here and maybe give some other suggestions to folks that are listening in.
Yeah, I mean, within different asset classes, I think real estate is probably one of the most tax efficient.
But just inside of real estate itself, inside of real estate, particular asset classes themselves.
Within real estate itself, we see higher depreciation in terms of larger commercial real estate, right? Probably like mobile home parks. We get quite a bit of depreciation, sometimes self-storage. Across all real estate asset classes, one of the key things to look at is investing in areas where land is cheaper. The reason being land is not depreciable unless we're talking about land improvements with like a mobile home park, right?
Sure.
But generally speaking, land is not depreciable. So, a $100,000 property, you're buying it beachfront, you're going to get a lot less depreciation than $100,000 property that's more inland, right? So that is true for real estate across all different asset classes.
I think one, looking, I guess, outside of real estate, one that, some of our clients take advantage of is they look at investing in oil and gas, exploratory drilling partnerships where, you can get, if they're set up the right way, you can get a 70-85% write-off in the first year of your investment. I mean, they come with risks, obviously, and you need to understand your investments and all that good stuff. But that is one asset class that, again, if it's set up the right way, it's a big write-off in the first year, which is obviously uncommon with a lot of investments, stock investments, writing that off until you sell the stock down the road. It's not like you buy a stock and get to take a $10,000 deduction because that's what you paid right now,
Right. Are there any major changes that are either have occurred or coming our way under Biden's 2023 tax plan? Anything that our listeners need to be aware of?
Well, what will come about in terms of possible changes for next year is a huge unknown. Because I think a lot of that will depend on the election, right? That's, elections always kind of change the tax profile. But what we do know, which has been great, is the changes that didn't happen for 2022. So this time last year, we were talking a lot about proposed changes to limiting or getting rid of 1031 exchange, or increasing tax rates for individual taxpayers. So we're just really happy that none of those really came to fruition. There was some talks about major changes to self-directed investing, right? A lot of our audience probably do that, where you're using retirement money for real estate. They were going to put huge limitations on that in terms of what you can invest in to basically limit syndication type of investments. But thankfully that didn't pass either. So far it was, we did a lot of planning and stressing out at the end of last year.
I mean, and actually, to be honest, the last 2 years, because it was leading up to the original, presidential election, that was all they were talking about. And so it was on the table for probably a couple of years.
Yeah. But what we do know, though, is next year. So this year we have 100% bonus depreciation, right, for real estate and other business assets. Next year, starting in early 2023, that's scheduled to go down to 80%. So it's a slight haircut.
Yep. And what is that phased out approach? Is it over 4 years, 5 years? I don't recall.
It's over I guess technically 6 years. So it drops 20% every year until it
Yes.
gets to zero.
Yes.
So
Okay.
But, I think so. Yeah, question we get a lot is like, is that going to happen? And I think, I wouldn't even look that far ahead.
Right.
Again,
right.
we might get 100% back, or they might just get rid of it entirely. But, as an investor, I think the action item is to take advantage of the benefits while they exist. Right now we have bonus. If you purchase something, put into service this year, you're eligible for that bonus depreciation, even if you don't, do cost segregation until next year. But, if you buy something next year, yeah, sure, we think it's going to be 80%, but it very well could go away in 2023, March or April or whenever that happens to be, right? So tax law could change any moment in time.
Yep. Absolutely. And the damn 1031, that thing's been on the chopping block too many times now.
right.
That's like their
Sick
favorite.
of hearing
Talk
about it.
Yes,
Yeah, I
yes.
know.
Learn some other numbers, guys. Come on.
That's it. I agree. So there was I think it was maybe I listened to an interview, and I don't recall who was interviewing you, Amanda, and there was some topic or conversation around clever ways to write off commercial real estate expenses or multifamily commercial real estate expenses on behalf of your kids. And I don't recall exactly where that conversation went, and so it came to mind, and I would love to speak to that if you could.
Yeah. So I mean, and that's not specific to commercial real estate. One of the things we look at from a planning perspective is income shifting. So shifting income, into the future or into legal entities, and shifting income to kids is one of those within the income shifting toolkit. So income shifting simply means instead of just giving money to your kids so they can spend on stuff, instead you have them earn that money. And so if you own an apartment building, for example, you can hire your kids in the summertime or whenever they're free, hire them to have them help out in your property, right? So with tenant turnovers, things like that. And I actually did that when I was a kid. My grandparents, I helped them out with their tenant turnovers. Now I didn't get paid, but but the concept is you actually not just have them do the work, but actually pay them. And so the money you pay them,
That was called a chore.
that was a chore.
Right.
It's like
Exactly.
you have no
Maybe get a
babysitter.
$5 bill or something.
Right.
But the concept is that you pay your kids, and if the payment is reasonable for what they're doing, it's a legitimate business expense, which reduces your taxable income. And then for the kids, depending on how much other income they earn, maybe up to the first $12,000 could be income tax free. So it's a great way to get a tax deduction by having your kids help out in your real estate business.
Is there an age restriction there? I mean, can I hire my 5 or 6 year old?
Yeah, there is no age restriction. I mean, think about it. Like there's babies out there that get paid for diaper commercials, right? So
That's true. Wow, I never.
I mean,
thought of
it
that.
just needs to be whatever they're doing and what you're paying them to do needs to be obviously reasonable for their age. So our 11-year-old is now our Zoom consultant. So
Yeah, but I mean, yeah. And so naturally, what we see in practice is younger kids like that, 3, 5 years old, they can't do much. Maybe they could be like a model for your shops or things like that, but that's not going to be like $12,000, right? Unless they're actually models by profession. But the older the kids are, the more they can do, and the more substantial the income shifting benefit will be. So like teenagers, 15, 16, 17-year-olds, those are great age groups where they actually do a ton of stuff, right? They can do a lot.
So I can just say, since my 6-year-old is so cute, I'm going to now put his picture and like our company logo and say that's why our company is worth, X millions of dollars. That's funny.
Well, the question is, would you pay my kid the same dollar amount, to do the modeling, right?
Yeah, no, absolutely. No, that's funny. Well, guys, talk to me about this book that you wrote, and I'm sure there's a litany of other strategies inside there that would be incredibly valuable to the listeners. Maybe pick, a few of the top ones that we haven't covered yet, and explain exactly what the strategies are and ultimately how they can be beneficial.
Gosh, I mean, there's so many. So, I mean, the reason we wrote our book was actually because, we were on a cruise and I was trying to read a bunch of tax books, and they were
this is
putting
what we
That's
do
what
on
you do on a
cruises.
cruise.
Yes,
I was
yes.
literally about to say the same thing.
I
Don't
know.
admit that. Don't admit that out loud. Come
Cruise.
on.
To be fair, I was like in a spa. I was kind of, just sitting there, right? Just relaxing. What are you gonna do? You're gonna read
I don't know if
something.
that's good justification or not, but go for it.
And the books that I brought with me was like really boring. It's kind of putting me to sleep. And I thought, you know what, we really need to have a more interesting book for like the investor, right? People who are not CPAs. So they understand like what are some of the strategies that can work. And so that was kind of the driving force in us writing a book. We just said, let's put this in story format and just share like story after story about what clients actually did effectively to save taxes and what the results are. And then also we have some nightmare stories in there as well in terms of what was, tax planning gone wrong. But really it's the book itself is not designed for CPAs. It doesn't have like code sections and a bunch of numbers. It's really just the concepts. But I think we talked about, we kind of briefly touched on some of those, right? Like income shifting. I think one of the most common myths that real estate investors have, especially those who are maybe just starting out or newer to investing, is not understanding what they can write off as a tax deduction. And really the IRS has the main criteria the IRS looks for is that the expense has to be ordinary and necessary to your real estate business. And so the answer to that might be different for, Kevin versus Matt and Amanda, or, single family versus multifamily as well. But really getting an understanding of like, what are some of the common tax deductions for real estate investors? And just the fact that you don't need to have a legal entity to take those write-offs. You just have to be in the business of investing in real estate, like have rental income or, whatever type of real estate you're doing.
Right. How do listeners get a copy of that book? Where's the best place to find it?
So our book is, you can get it on Amazon, or also Bigger Pockets is our publisher. So you can get it from Bigger Pockets as well.
Okay, fantastic. And for those that want to learn more about you guys, aside from the book itself, I mean, where's the best place to track you down? I mean, your website, do you have additional resources that you'd like to share?
Yeah, the best place to find more information about us is on our website, which is KeystoneCPA.com. We have a lot of great resources on there, some toolkits and stuff that people can utilize to kind of help, from a resource perspective. We're also very active on social media.
Yeah, so we have a tax savings toolkit, which basically goes more detail into like income shifting, some like you asked the question about how old they have to be. So we talk more about what are the things they do, how do you document it? And then we have a tax opportunity finder in our toolkit. Because one of the questions we get a lot is like, how do I know if I'm overpaying in taxes? And it's like, well, I can't tell you, I don't know unless I look at all your stuff. But we put together like a self-assessment tool where you can just answer these questions. They'll tell you kind of a score of how you're doing. What's the likelihood that you may or may not be overpaying in taxes, and also just like what are the planning areas that you should be talking to your tax advisor about too, if you're missing out. So you can find all that on our KeystoneCPA.com website. But on social media, we're all over social media. But if you want to follow us for tax stuff, just look up the Keystone CPA. If you want to see what we're up to, in the tax world and outside, and pictures of our kids and what we're eating for the weekend, you can follow me on Instagram for Amanda Han CPA.
Well, fantastic. Well, Amanda and Matt, it's been fun having you guys here. I really appreciate you coming on the show and sharing all your great insights. It's been a pleasure.
Yeah,
thanks for having us.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.